Topic explains yield and yield spread measures for floating rate instruments and money market securities. Unlike fixed rate bonds, floating rate instruments have coupon payments that adjust periodically according to a specified market reference rate plus a quoted margin. These securities are designed to reduce interest rate risk because coupon payments move with changing market conditions. Common floating rate instruments include floating rate notes, FRNs, bank loans, and short-term money market securities. Understanding the valuation and yield measurement of floating rate instruments is essential because their pricing behavior, risk exposure, and return characteristics differ significantly from traditional fixed-rate bonds within global fixed-income markets. Floating rate notes typically reference short-term benchmark interest rates such as SOFR, Euribor, or other interbank lending rates. The coupon payment equals the reference rate plus a fixed quoted spread established at issuance. Because the reference rate resets periodically, the market value of floating rate instruments generally remains close to par value unless credit risk or liquidity conditions change materially. Investors favor FRNs in rising interest rate environments because coupon payments increase as benchmark rates rise. Issuers may also benefit when short-term interest rates remain low, although future borrowing costs become uncertain due to fluctuations in market reference rates over the life of the instrument. A key concept in evaluating floating rate instruments is the quoted margin, which represents the fixed spread added to the reference rate. The quoted margin compensates investors for credit risk and liquidity risk beyond the benchmark rate. However, market conditions may change after issuance, causing investors to demand a different level of compensation. The market-required spread that equates the present value of expected cash flows with the bond's market price is called the required margin. If the required margin exceeds the quoted margin, the instrument will trade below par value. Conversely, if the quoted margin exceeds the required margin, the floating rate note will trade above par due to its relatively attractive coupon structure. Yield calculations for floating rate instruments differ from those used for fixed rate bonds because future coupon payments are uncertain and depend on future reference rates. Analysts commonly use discount margin as a measure of expected return. The discount margin represents the average spread over the benchmark reference rate that investors expect to earn, considering both periodic coupon payments and any capital gains or losses if the instrument trades away from par. The discount margin therefore reflects market perceptions of credit quality, liquidity conditions, and expected future interest rates. Investors compare discount margins across securities to assess relative value and determine whether compensation is adequate for associated risks. Floating rate instruments generally exhibit lower duration and interest rate sensitivity than fixed rate bonds. Because coupons reset periodically to prevailing market rates, price fluctuations caused by interest rate changes are usually limited. The time remaining until the next coupon reset date largely determines interest rate exposure rather than the instrument's final maturity. Consequently, FRNs are often used by investors seeking protection against rising rates or reduced duration risk within diversified fixed-income portfolios. However, floating rate securities are not risk-free because changes in credit spreads, liquidity conditions, or issuer creditworthiness can still significantly affect market prices and expected investment returns over time. The topic also discusses yield measures for money market instruments, which are short-term debt securities with maturities of 1 year or less. Examples include treasury bills, commercial paper, certificates of deposit, and repurchase agreements. Many money market instruments are quoted using discount-based conventions rather than traditional bond yields. For example, treasury bills are often quoted using bank discount yield, which calculates return as a percentage of face value rather than purchase price. Because different instruments use varying conventions, analysts must convert yields to comparable annualized measures when evaluating short-term investment opportunities across money market securities and floating rate instruments. Another important yield measure for money market securities is the effective annual yield, which accounts for reinvestment and compounding effects over a full year. Bond equivalent yield and money market yield are also commonly used to standardize comparisons among instruments with different maturities and quotation conventions. Investors rely on these annualized measures to compare short-term investments accurately and assess relative returns after adjusting for compounding frequency. Since money market instruments are often used for liquidity management and capital preservation, precise yield calculations are essential for institutional investors, corporations, and financial intermediaries managing short-term funding and investment portfolios. Topic ultimately demonstrates that floating rate instruments and money market securities require specialized yield and spread analysis because of their variable cash flow structures and unique quotation conventions. Concepts such as quoted margin, required margin, discount margin, and effective annual yield help investors evaluate expected returns and assess compensation for risk. Floating rate instruments provide valuable protection against changing interest rates, while money market securities support liquidity management and short-term financing activities. Understanding these valuation techniques and yield measures enables analysts to compare diverse fixed income instruments effectively, manage duration exposure, and make informed investment decisions in evolving interest rate and credit market environments.